A wonderful day to you all. Welcome to Nifty Sense. Today, the Indian markets felt like a giant cargo ship hitting a patch of rough, icy waters. While the surface looked calm over the weekend, a sudden shift in the global winds and some internal engine trouble in our heavyweights caused a noticeable tilt. The mystery of the phantom floor. As the bell rang this morning, something strange happened. The Nifty 50 didn't just fall. It dove straight toward a psychological trapdoor. But as it reached the 25,500 mark, an invisible force, a phantom floor, seemed to catch it. Who was holding the floor, and why were they buying while the smart money, FIIs, was sprinting for the exits? Today we decode the hidden tug-of-war between global fear and local resilience. The closing ledger, the 19th of January 2026. Nifty 50 to 25,585.50, filled down pointing triangle 108.85, minus 0.42%. Sensex 83,246.18, filled down pointing triangle 324.17, minus 0.39%. Institutional footprint, FIIs, the foreign tourists, net outflow of 4,781 crore rupees. Like tourists leaving a beach because they heard a storm warning, global investors are pulling back. DIIs, the local residents, net inflow of 4,234 crore rupees. Think of these as the locals who know the house is solid and are buying the furniture the tourists are selling at a discount. Top 10 market headlines. The impact pulse. Trump's tariff ultimatum. President Trump's weekend vow to impose escalating tariffs from February 1st on European nations has sent a shockwave through global trade routes, stoking trade war fears. The Wipro washout. Wipro plummeted 8.2% after a disappointing Q3. Higher labor costs under the new labor code acted like a surprise tax on their profit margins. Reliance's mixed signals. Despite a massive 18,645 crore rupees profit, the market punished RIL minus 3% as growth expectations were higher than the actual delivery. HDFC Bank's Fortress. The private lender beat estimates with a 18,653 crore rupees profit, acting as the primary anchor preventing a total market meltdown. RBI's heavy hand. The RBI demanded a combined 1,783 crore rupees in extra provisioning from HDFC and ICICI, acting like a building inspector requiring extra fire insurance. BHEL's power surge. Profit more than tripled to 382 crore rupees, proving that the industrial renaissance in India is still alive and kicking. Indigo's Flightpath shares soared 4% as the aviation moat strengthened amidst travel demand, making it the day's top performer. CG Power's global win. A 900 crore rupees US data center order showed that Indian engineering is now a global export, not just a domestic service. FMCG's defensive shield. As the world turned volatile, investors hid in essentials like HUL, treating soap and tea like a financial bunker. Budget fever. With February 1st approaching, the market is becoming stock-specific, ignoring the broad index to find hidden gems in infra and energy. Sectoral pulse. Who's breathing? Who's wheezing? The gaining trio. Green flags. FMCG, plus 0.67%. The business insurance of the market. When people are scared of trade wars, they still buy toothpaste. Aviation/auto, plus 0.13%. Driven by Indigo and Maruti, these sectors represent the supply chain of human movement. Power/infra, showing localized strength due to massive order book wins. CG Power, BHEL. The losing trio, structural weakness. Realty, minus 1.99%, the most sensitive to interest rate fears. High costs are currently acting like clogged pipes in the housing market. Media, minus 1.84%. Continued struggle with ad spend as corporate giants tighten their belts. IT, minus 1.5%. Dragged down by the Wipro weight, the sector is facing a relative strength crisis compared to US tech. Market breakdown, the supply chain logic. Why did we fall? Think of the Nifty 50 as a giant grocery store. Tariffs, the global toll. Imagine if the road leading to your store suddenly started charging a 20% toll. You'd worry that fewer customers would come, and goods would get more expensive. That's what Trump's tariff talk did to the sentiment today. The Wipro/Reliance leak. If the two biggest fridges in your grocery store start leaking, missed earnings, the whole store smells bad. Investors don't just sell those two. They worry about the inventory in the whole aisle. FII-DII crossover, the tug-of-war. FIIs are like summer renters. They leave at the first sign of rain. DIIs are the homeowners. They see the rain as a chance to water the garden. Today the homeowners were out in force, preventing the phantom floor from breaking. Green flag deep dive, two stocks showing institutional footprint. Stock 1, CG Power and Industrial Solutions. The narrative. While the index was bleeding, CG Power stood tall. The value moat, the digital castle. They just secured a 900 crore rupees order for a US data center. Think of a data center as the brain of the modern world. CG Power is building the skull and nervous system, the power infrastructure. Institutional footprint. Huge delivery volumes suggest that while retail was panicked, big funds were accumulating in this zone. Their moat is their order book visibility. They have work lined up for years, making them immune to short-term economic hiccups. Stock 2, Interglobe Aviation, IndiGo. The narrative, a 4% jump in a red market, is the definition of relative strength. The value moat, the sky monopoly. IndiGo is essentially the national highway of the Indian skies. As smaller airlines struggle with costs, IndiGo's scale allows it to buy fuel cheaper and fill more seats. Management commentary. They are seeing yield stability, which is a fancy way of saying they can keep ticket prices high without losing customers. This is a price setter, not a price taker. The dark horse, the infrastructure quiet accumulation. While the Nifty was down, have you noticed BHEL and GR Infra? Despite the red index, the capital goods sector is showing structural strength. This is the dark horse. Institutions are quietly moving money into companies that build bridges, power plants, and railways. Why? Because the union budget is just 12 days away. The market is betting that the government will double down on business infrastructure. This isn't speculative gambling. It's a bet on the foundation of the country. The retail compass, decoding the behavioral gap. To wrap up today's deep dive, we must look at the behavioral gap, the difference between what the market does and how the average investor reacts. Think of the stock market like a professional sports league. When a star player, like a Nifty heavyweight, gets a minor injury, the fans, retail investors, often panic and start selling their season tickets, fearing the whole season is lost. Meanwhile, the team scouts, institutional investors, are busy looking at the bench. The younger, hungrier players, mid-cap stocks or specific winners like CG Power, who are about to get their big break. The trap of index anchoring. Many investors today feel poor because the Nifty 50 ended red. But if you look under the hood, nearly 40% of the Nifty 50 stocks actually closed in the green. This is a stock picker's market. If you only look at the scoreboard, the index, you miss the fact that certain players are having a career-best game. The pre-budget fog. We are currently in what I call the information twilight zone. From now until February 1st, every rumor about tax changes or infrastructure spending will cause micro-volatilities. Professional strategists use this fog to hide their footprints. They aren't buying the hype, they are buying the requirement. India requires power, CG Power. India requires logistics, IndiGo. And India requires basic goods, FMCG. Conclusion. The lesson of wealth preservation. Today's core lesson is about the anchor. In a storm, the ships that survive aren't the ones that try to outrun the wind. They are the ones with the deepest anchors. Wealth preservation thought. In the market, your anchor is value. When heavyweights like Wipro or Reliance fall, it creates a gravity well that pulls everything down. But stocks with strong order books, like CG Power, or defensive moats, like HUL, act as your lifeboats. Don't look at the red numbers as a loss. Look at them as a repricing of risk. If you own a house and the neighbor sells theirs for cheap because they are in a hurry, your house hasn't become worse. It's just a relative strength test.